Welcome to This Explainer. Today, we're decoding the mystery of Salesforce's current market position. We're strictly looking at the objective facts ahead of their massive Q2 earnings. It's a fascinating situation. Honestly, we're balancing skyrocketing technological adoption against shifting market sentiments. So let's just jump right in. Here's our agenda to unpack the whole debate. We'll start with the market paradox, take a look at Q1 financials versus reality, dig into their Agentforce AI strategy, review the Wall Street consensus, and then wrap up with the upcoming catalysts. Section 1. The market paradox. Surging profits versus sinking shares. Okay, so there's a stark contrast happening right now. On one hand, Salesforce's 52-week high is sitting pretty at $269.11. But on the flip side, the current trading price is sitting significantly lower at roughly $206.09. Despite having strong underlying fundamentals, which we're definitely going to get into, the market has aggressively repriced this software giant. To put that drop into perspective, the stock is sitting nearly 30% off its absolute peak. Overall, that puts it down roughly 28% year-to-date, with the 52-week low dipping all the way down to $146.32. You know, when a company of Salesforce's massive scale drops by nearly a third of its peak value, you really have to stop and ask yourself, what exactly is the market pricing in here? Well, the answer actually lies in a newly coined industry term. This massive sell-off is largely being driven by what insiders are dramatically calling the SaaSpocalypse. Because, let's face it, the tech world absolutely loves a good doomsday portmanteau, right? It's basically the underlying market fear that autonomous AI agents could effectively render traditional software-as-a-service business models obsolete. And since Salesforce is literally the world's absolute largest CRM provider, they're sitting at ground zero for this exact concern. Investors are terrified that AI is going to replace the very software seats that Salesforce relies on. Section 2. Q1 financials versus reality. A record-breaking quarter ignored. When you look at the numbers, the underlying fundamentals are just staggering. Revenue came in at $11.13 billion, representing a 13% increase year over year. But the real standout, that's the bottom line. Adjusted earnings per share hit $3.88. That is a massive 24% beat over Wall Street's $3.13 estimate. By pretty much any traditional metric, this was a phenomenal, record-breaking quarter. And listen, this isn't some one-off fluke either. Salesforce has absolutely crushed earnings estimates for 4 consecutive quarters now, delivering positive surprises ranging from 5% all the way up to 25%. The profit engine is undeniably running hot. Yet, remarkably, after this massive Q1 beat, the stock actually dropped. No way, right? So why exactly did that drop happen? Well, markets are forward-looking mechanisms. Investors completely brushed off the historical Q1 beat because the Q2 revenue guidance came in just slightly soft. Management guided for $11.27 billion to $11.35 billion, which fell just shy of what the most optimistic analysts were hoping for. For Wall Street, it signaled a potential deceleration in top-line growth. On top of that, the market got a little spooked by a shift in cash flow. Salesforce cut its full-year free cash flow growth guidance roughly in half. Why? Because they issued $25 billion in debt. Now, they didn't do this out of desperation. They actually did it to fund an incredibly aggressive $25 billion accelerated share repurchase program. And that's actually part of an even larger $50 billion total authorization. It's a massive vote of confidence from management for sure, but the mechanics of taking on debt to buy back stock heavily impacted their near-term cash flow metrics. And that made some investors pretty nervous. Section 3. The Agentforce AI strategy, the explosive growth of Salesforce AI. Now, the adoption of this platform is happening at just a blistering pace. In Q4 of fiscal 2026, Agentforce had $800 million in annualized recurring revenue, or ARR. Just 3 months later, in Q1 of fiscal 2027, that figure spiked to $1.2 billion. Think about that. They added $400 million in net new ARR in a single quarter just for this specific product. That translates to an absolutely astounding 205% year-over-year increase in Agentforce ARR alone. For an enterprise software company to generate triple-digit growth on a billion-dollar product run rate is incredibly rare, and it directly counters the whole narrative that Salesforce is somehow being left behind in the AI revolution. The broader AI metrics are honestly just as staggering. When you combine Agentforce with their data cloud, total AI-related ARR is now nearing $3.4 billion. That's more than triple what it was just a year ago. Plus, the number of Agentforce customers actually in production grew 50% quarter-over-quarter. And if we look at pure usage, the platform processed a mind-bending 28.6 trillion tokens in Q1, which is up 152% sequentially. Enterprise adoption of their AI ecosystem isn't just some glossy marketing pitch. The data proves it's very, very real. But to maintain an objective view in this explainer, we really have to look at what the bears are seeing. Legacy areas like Tableau and Marketing Cloud remain significant weak spots. Channel checks are showing very little net new customer demand in these older segments. And even worse, reports suggest customers are becoming a bit, contentious around renewals. This implies that whatever growth Salesforce is managing to squeeze out right now is relying heavily on upselling existing customers, rather than bringing brand new logos through the door. Section 4. Wall Street Consensus, the bull versus bear debate. So there is a profound fracture in the market right now. On one side, you have firms like Oppenheimer and Cantor Fitzgerald standing strong with outperform and overweight ratings, both targeting $250. BMO and Citi are even raising their price targets. But then, on the completely opposite end of the spectrum, Bank of America reinstated their coverage with an underperform rating and a really low $160 price target. Their justification? They believe Salesforce is facing a structural, AI-driven reset, not just a normal cyclical downturn. The division among the experts here is honestly pretty wild. Despite those stark outliers, though, if we zoom out and look at the broader picture across 54 different analysts, the consensus remains surprisingly bullish. The aggregate rating is a moderate buy with an average price target of about $242. Compared to current trading levels, that implies roughly an 18% upside for the stock. And this perfectly captures the ongoing debate you have to weigh as you're evaluating this space. The bull case basically argues that Salesforce is historically cheap, trading at just 13 times forward earnings with an incredibly healthy 9.4% free cash flow yield. It's a classic value play with a nice AI kicker. But then the bear case counters that, hey, it's cheap for a reason. AI disruption is actively cannibalizing software seats, and their legacy products are grinding to a halt. So are you buying a deeply undervalued tech titan, or are you catching a falling knife in a shifting technological landscape? Section 5. The upcoming catalysts. What's next for Salesforce? The narrative of doubt that took hold back in May during the Q1 earnings call is going to face its ultimate test in the coming weeks. We have the Q2 earnings report dropping on August 26th, and that's followed quickly by the massive Dreamforce event kicking off on September 15th. For August 26th, the expectations are set at roughly $3.27 to $3.28 for EPS, and about $11.32 billion for revenue. But listen, just hitting those numbers isn't going to be enough. Investors are desperately looking for management to provide definitive proof of organic revenue reacceleration in their forward guidance. And then, in mid-September, Dreamforce kicks off with the explicit theme of the agentic enterprise. This is exactly where Salesforce needs to prove that their AI agents aren't just cool tech demos, but highly adoptable, sticky tools that are actually going to drive their next decade of growth. If they show that reacceleration and successful AI deployment, the upside re-rating could be massive. But if legacy clouds continue to drag and demand remains tepid, the stock will likely stay under some heavy pressure. We've laid out the objective facts in this explainer: the surging AI metrics, the legacy struggles, the cheap valuation, and that looming threat of the SaaS apocalypse. So now the final analysis is up to you. Looking at the data ahead of Q2, are you bullish or bearish on the future of Salesforce? Take that thought with you, keep learning, and thank you so much for joining us today.